Back in 1996, Zurich created an insurance policy dedicated specifically to lenders. What we found was that the lenders were often driving the requirements to have an environmental policy in place or some sort of environmental indemnity. So we created a policy that was for the lender's collateral protection, and it was based on two things. One, the default, and secondly, having an environmental incident happening during the policy period and at a covered location. The idea of the policy is to provide first-party cleanup coverage for any environmental issue, as well as any third-party bodily injury or property damage that would be associated with that environmental incident. Lenders are typically using our environmental policies in one of two different ways. First is through what we call a one-off transactional deal. That's underwritten and built around the one individual loan that lender is making. Typically that is driven by a few different issues from the lender side. One might be the on-site operations of the company that they're loaning to. Two might be some adjacent property issues that they're concerned about. Maybe an underground storage tank at another facility. But basically that the lender's trying to protect their asset. Traditionally, the lenders have done a couple of different things. One, they've either required an environmental indemnity or required some sort of an escrow to be put in place. And what they've decided, or what they found, was an environmental insurance policy could also create the same sort of protection for themselves. What they found from their borrowers is that often the borrowers didn't want to tie up their capital into an indemnity or into an escrow. So the environmental insurance policy was the most cost-effective way for them to actually provide the coverage that the bank needed. The other thing was, from a turnaround perspective, to put the environmental policy in place is a much quicker, much more effective way to handle any environmental issues, rather than going out to a third-party consultant in order to get a phase one done, which can often take 2, 3, 4 weeks, whereas a policy can be turned around very, very quickly, often in a matter of 3 to 5 days. The second area that we've utilized the environmental lenders program is through what we call a portfolio policy. What we do there is we actually work with the lenders to put in place a policy that's going to cover all of their commercial real estate loans, and it's built into one policy. Now, the benefit of that is we have our own online system where the information comes directly from the lenders into that system. We underwrite it. Typically takes us anywhere between 36 to 48 hours to turn around a decision on an individual portfolio loan. And the cost of those policies is actually directly competitive against having a phase one done. So we're looking for a complete spread of risk across all of the lenders' portfolio of commercial-backed loans, and again provides a convenient, fast, effective way for them to make sure that they have a true risk management tool to protect themselves against any sort of environmental issue or default. There are a few key benefits to the portfolio program. First, it provides a competitive advantage for the lender through cost savings at closing time. The typical cost to add a portfolio loan to the policy is actually less expensive than getting an environmental report completed on a given facility. Second, it streamlines the lending process, because if you're going to get an environmental report, it can take anywhere up to 2, 3, 4 weeks versus our ability to turn around an individual loan within 36 to 48 hours. Third, rather than just having a snapshot, a picture in time where you're looking at an environmental report, our policy is actually going to provide coverage for the full length of the loan period, providing a much broader, longer-term solution for the lender. Oftentimes, lenders are not looking to take on a lot of environmental risk, and the policy will actually allow them to look at loans that they sometimes wouldn't even consider to make. Through the policy, you're transferring your risk to the insurance carrier, which again gives you the ability to write more and often different types of loans than your competitors will be willing to look at.